Hello, happy Sunday, DGI enthusiasts out there. It is Colby, the DGI Crab, coming at you with the 4 tiers video that I do each and every week here on the channel. We're going to break down the 60 high-quality dividend growth stocks that I've chosen to focus my portfolio on, and I have split those into 4 separate categories or tiers based on the age and timeline of the investor, which I believe is the most important metric that a dividend growth stock investor should take into consideration. His or her own age and time horizon, how long they're going to be in the market, how much time they're going to have for their dividends to compound, grow, snowball, get to financial freedom. There's more than one way to skin a cat, so to speak. And if you are 20 to 25 years old, the way that you ought to go about doing things is going to look a lot different than if you're starting out at age 50 or even 55. The name of the game is dividends, but not all great dividend stocks are created equal. That's the whole theme of this channel. And if you're new, welcome here. I hope that you'll like and subscribe. If you're not new, if you've been here for a while, please tell your friends. The videos have been a little stagnant over the last few weeks. I haven't put out as many as I typically have in the past. I do apologize for that. It's just been a crazy start to the year. And unfortunately, this past week, I got absolutely waylaid with COVID. Jeez, talk about getting on board with something a few years too late. I've always been a little bit behind the trends, the fashionable trends, I suppose, and the stupid thing finally got me, and I was down with it for pretty much the entire week, and here I am on Sunday, about back to normal again. We'll see how I get through this video. Still a little short of breath here and there, but I think I'll be able to tough through it here for you guys. So we're going to have a couple of new stocks going into the buy zone here for this week, which is pretty exciting. Kind of an overall up week on the stock market from what I could see. Got some things that had been in the buy zone that went out, and some things that were not previously in the buy zone went in. That's just typically how it's going to go in the stock market. We don't want to necessarily try to time the market with our money, but we do want to time when we're putting money into individual stocks. Now, I'm not a professional financial advisor. Please do your own due diligence and all of that good business before you invest. Don't do anything because I told you or not to do it. I am just sharing with you my personal strategy and how I am working my way to financial freedom with dividend growth stocks. Now, for anyone who is new to the channel, I will just point out this is what I do week to week. My personal strategy. I do 50% of my money into age-appropriate ETFs for automatic diversification. And for single stocks, I'm looking for the ones that are yielding at least 30% or more above their 4-year average yield, which for me indicates they are a bargain at the time. I have a side list of my top 10 favorite stocks, and if any of those happen to be yielding 20% or more above their 4-year average, I don't care particularly what tier they happen to be in, I will add to them at that point in time, no matter my age. Now, I do remain within my tier outside of that, unless there does happen to be a stock in a different tier that's yielding 50% or more above the 4-year average yield. So I'll point those out as we go along. There do remain a couple of them. Let's see, I believe 3 of them. That's right, 3 that are in that category still out of the 60. And then finally, if there's no viable stocks within my tier, I add more to ETFs. Again, I'm not trying to time the market. I'm looking for time in the market, and with ETFs, I am all about dollar cost averaging. Now, as we go to the spreadsheet here, we're looking at the valuation tab where I'm taking the 4-year average yield, comparing it to the current day yield, and getting the undervaluation metric. This is an extremely similar metric that you'll see on the website Simply Safe Dividends. I've simply reverse engineered this here on the spreadsheet for myself. If it's in the green, it's 30% or more undervalued. And if it's in the yellow or the red, it's just stocks that I'm not adding new money to. I'm simply holding them and allowing my dividends to reinvest along the way. This is the tab for the Tier 1 investors aged 18 to 30. This group of stocks cumulatively should get you between 1 to 2% starting yield. But what we're really looking for with this group is a strong annual dividend growth rate of comfortably above 10%. Nike and Nordson have been in the buy zone in this category for quite a while now, and United Health has joined the party. So, for those of you who are out there possibly following along as tier one investors, if you've been getting bored just adding a lot of Nike and Nordson week in and week out, you've got something new that you can add. United Health, $429 billion company by market cap. They are finally in that buy zone. We've been keeping an eye on them for the last couple of months. They've been flirting with it, hadn't quite gotten there yet. Patience pays off for those of us who are willing to wait for that bargain. $4.66 a share looks like a good deal to me. All right, tier 2, age 31 to 41, starting yield to be a little higher in this category, more like 2 to 3%, and what we're looking for is a high single-digit annual dividend growth rate. If we can get up to 10% on a year, that'd be really nice, but usually this group's going to be anywhere from 7 to 9% year over year. We've got Hershey, Target, NextEra Energy, and American States Water, all within that buy zone. Oh, and just to point out again, Nike is in that 50% or more undervalued, and so is Hershey. Now, Hershey had dipped all the way down into the $150 range, recovering back up to 172. Still a fine value there. Still a stock I'm adding a lot of as I'm still in tier 2. And Target now is starting to threaten Hershey as the most undervalued stock in this category. And I'd like to actually see Hershey get out of that number one spot. It's been up there for quite a while now. I'm not complaining. I've been enjoying adding Hershey. I think it's a great company to add on to. I've been enjoying getting a yield on it that's, gosh, I mean, I got starting yield on it at more than 3.5% over these last couple of months at times. But I think Target is starting to get to the point where it's threatening to get into that number one spot. We'll just have to wait and see there. NextEra Energy and American States Water. You cannot go wrong with these two utilities. Not the most exciting names or companies out there, but if you want good, solid year-over-year dividend growth performers, NextEra and AWR both have nice long track records of increasing dividends to the shareholders. Nothing else here jumps out right now. McCormick is the only one that's even close to the buy zone in that fifth spot. Certainly waiting on it, and anything else below is just a hold for me right now. Tier 3, age 42 to 53-year-old investors, starting yield getting a little higher, 3 to 4%. Overall increases, really we're looking for mid to high single digits and 5 to 7%. This group last year was a bit of a laggard when it came to dividend increases as a group. But it's certainly a great group of individual stocks here. Archer Daniels Midland continues to be on top of the pile here. Definitely above the 50% undervalued. And Hormel had briefly gotten to that point a week or two ago, and I even added a little bit of Hormel to it, even though it's not in my tier. It hit that 50% mark, so I grabbed a little bit of it. That was when it was down in the $28 range. It's recovered a little bit more from there, but still way down in the dumps. Genuine Parts Company, they've kind of edged in and out of the buy zone over the last couple of months at 121. They're a good buy to me. Pepsi, one of my top 10 favorite dividend growth stocks, 27% undervalued, but if it's in my top 10, I only need to see 20% or more, and I am all over it. And then finally, our tier 4, age 54 and older investors, we want that starting yield to be at least 5% as a group, if not better. And maybe 2 to 4% annual dividend raises year over year, just so when you're at that point where you're not reinvesting your dividends anymore, you're still getting enough raises out of this group to keep up with inflation. Still nothing in the buy zone for this particular group right now, so just a lot of patience is going to be in order. At some point in time, we're going to have some deals that we can have, whether it be in the real estate, like with Realty Income or NNN, or with our BDCs like Maine or Ares Capital. But none of this stuff is trading cheap right now. Now I have mentioned my top 10 favorite stocks. This is the group. It's not a separate group of stocks, you guys. These are all found somewhere between tiers 1, 2, or 3. And I just like to keep them on their own tab here so I can keep an extra close eye on them. Pepsi is the most undervalued right now and the only one ensconced in the buy zone. We had some opportunities to get J&J a couple of months ago when it was trading down below $150 a share. Right now I'm just sitting back and waiting on that one again now that it's up above 160. Nice to see J&J recover. I thought they were getting hit a little bit too hard. All right, now the strategy. So I won't spend too much time on the ETF side of things, but like I said, I do 50% of new money into ETFs. Tier 1, this would be my breakdown of it, S&P 500, small cap, dividend appreciation, international. Tier 2, dividend appreciation, S&P 500, small cap, international. Tier 3, higher dividend yields, SCHD, VYM, DHS. Those are my top 3 for this particular category. And then for tier 4, we've got our stock presence here, as well as some alternative high yield investments that could be really handy for income seekers. Bonds, preferred shares, MLPs, covered call ETF, Devo, JEPQ, and SPY. And then, of course, international as well. Now, here's the purchase breakdown or the allocation. For that tier 1 group, I'd be looking at Nike, Nordson, and UNH as the 3 in my personal category that are in the buy zone. I'd throw money at Pepsi, top 10 favorite stock, and then a little bit left over for Hershey and ADM, the 2 outside of my category that are 50% or more undervalued. Hopefully that makes sense. For tier 2, the emphasis would be on the tier 2 stuff first. So Hershey, Target, AWR, NextEra Energy. Grab the Pepsi, and then ADM and Nike as the 2 50% or more outside of my tiers. So I'm getting a lot of different opportunities to add a little bit of money to a lot of different positions, not only within my own tier, but in other tiers as well. Tier 3 would be Pepsi, ADM, Hormel, GPC, and then dipping down to get some Hershey and Nike for the value there. And then for tier 4, since there's nothing still to buy in that particular category, instead of doing 15% and 5s down the board on these, I'd be doing 30, 10s down the board. And then instead of doubling down on my international investment, I'd keep that at 5% overall. I'd still have 5% more left over. And I'm going to keep throwing that extra 5% into Pepsi in this group as well, because I think that the yield is high enough. And if you're going to add to an individual single stock at this age, you might as well put it into a really large, super safe blue chip like Pepsi. And then we'll take a minute here to look at the DGI Crab Channel portfolio and see how it's coming along. I've been adding $100 a week to this portfolio for a little while now. It's in week 19, $1,900 overall invested. And I've got it sorted here by the amount of money that I have invested in the individual stocks, with VIG getting the most of the money, Hershey in the number 2 position, and VOO in the number 3 spot. And, I've got some smaller positions down here. Hormel and Starbucks are only $5 investments right now. They just didn't stay in the buy zone very long when I had the opportunity to initiate the small position. NextEra was a $5 position, but this past week I got to add another 5 to it, and that put it up to 10. So, some smaller positions down here. But listen, when I bought Starbucks, it was down in the $90 range, and now it's up at $111. So, overall that $5 position is worth $6.26. So I'm way up on it. But I'm not going to press and add more money into something if it looks like it's overvalued. I'm going to keep focusing on other positions that look like they are undervalued, spreading the love around, being very well diversified, and pretty happy with the way the portfolio's coming along. So that's the video, you guys. Let me know what you're buying down in the comments below, and I'll see you